The minutes from the RBA's September the 4th meeting have revealed a decrease in the prices of commodities such as iron ore and coal may quickly affect export prices, weakening the outlook for Australia's economy. Today I'm joined on the line by Amber Rabinov, Senior Economist at ANZ in London. Amber, how are you feeling about the Australian economy and what are you expecting in terms of growth?
Well, if we look at the aggregate numbers for the Australian economy, they're actually relatively positive, and we're expecting trend growth of around 3.5% to 3.75% in 2012 and 13. Now, that said, there's quite a divergence between the performance of different sectors of the economy, and we're seeing business investment, and particularly mining investment, being the major driver of growth this year and next. For instance, we forecast business investment growth of about 17% over this year and next. But what we're seeing increasingly being focused on in the media are the more visible sectors of the economy, particularly the household sector, such as consumption and housing investment. They're experiencing much more modest growth. Housing investment, for instance, is expected to contract this year by about 5%. We also expect the unemployment rate to edge higher, up to around 5.5% from its current 5.1% level. And as you highlight, there are significant risks to the outlook due to the weakening external environment, especially China, and these impacts on commodity prices. One traditional cushioning factor, a weaker currency when commodity prices fall, has not actually eventuated at this time due to continued interest from offshore investors for Australian dollar-denominated assets, and this presents a bit of a risk to our outlook.
Australia's central bank stated that the country's benign inflation forecast offered scope to cut interest rates if the economy weakens. Do you expect further cuts soon, and when do you think they will be implemented?
Yes, we do believe the RBA will cut rates soon, and in fact we do think the central bank will reduce the cash rate by 25 basis points at its upcoming October meeting and again in November, so that will take the cash rate level down to 3%. Further, we expect the bank to maintain an easing bias thereafter. Now, the main reason behind our expectation is the fact that lower commodity prices, coupled with the persistently high Australian dollar, will have a significant contractionary effect on the economy. Now, as you alluded to, inflation is comfortably at the lower end of the RBA's 2 to 3% medium-term target band at the moment. Global growth also continues to moderate, and leading indicators of unemployment are deteriorating. We're also seeing fiscal policy tightening over the coming years. As a result, we are expecting interest rate cuts by the RBA in a couple of weeks' time.
The minutes also revealed the RBA believes the Australian dollar is somewhat overvalued. However, it said there was significant uncertainty surrounding the Australian dollar assessment. Amber, what do you think?
Yeah, that's right. And the RBA referred in the minutes to the more traditional currency models of the Australian dollar when making this comment. So traditionally, we tend to see the Australian dollar being driven by two major factors: commodity prices and also interest rate differentials. Increasingly, however, and the RBA has commented on this for the past year or so, we've been seeing strong demand from offshore investors for Australian dollar-denominated assets, so particularly government and semi-government bonds. Now, these investors have been attracted to both the yields that these assets offer as well as the relative safety that they provide, given that Australia is a AAA-rated economy. So, yes, I agree with the RBA's assessment that potentially on traditional valuation methods, the Australian dollar looks somewhat overvalued, but also keep in mind that currencies can trade away from their so-called fair value for a number of years.
And finally, how is the Australian dollar performing against the US dollar at the moment, and what is your outlook for this pair?
Well, given the supportive offshore investor appetite that we have seen and also the broader weakness in the US dollar, we actually expect the Australian dollar to remain around current levels for an extended period of time. So it's currently trading around 104.30 against the US dollar at the moment. We're looking for the recent trading range that we've seen over the past couple of weeks to extend through to the end of the year. And we think that there's potential for the currency to lift towards 107 against the US dollar by mid-next year.
Thank you, Amber, for discussing your views today. I'll be back tomorrow to look at 3 currency pairs for Wednesday's Targets in Focus, so make sure you tune in for that. Goodbye.